All right, Hunter. Today we are going to tackle the curious case of hedge funds. Now, there's been some news around them lately, especially with these pass-through fees that I want to get to. But I think a lot of investors, and especially retail investors, don't have a firm grasp of first, what the heck a hedge fund even is, and then two, what are the fees, what are the underlying dynamics behind those? So I'm excited to get into that today.
And that's a great point, Victor, because hedge funds exist in kind of this side pocket of the financial industry where they're still regulated by the SEC, but that regulation looks very different, as well as, their lack of transparency, their high fees, and, just generally like different approach to the investment industry. And so, for a lot of those reasons, they've been, kind of either favored or unfavored by investors. It's you either love them or hate them kind of thing. I feel like, at least as far as people I've interacted with, people generally have strong opinions on hedge funds, whether it's a waste of time and money or a really valuable tool to drive alpha. But recently Bloomberg published a great article kind of walking through those pass-through fees that you mentioned. And, I want to talk a little bit about that today, but also, let's cover really, like you said, what is a hedge fund and, kind of what role do they play?
Yeah, absolutely. And I think fundamentally, hedge funds are investment vehicles. So, an ETF could be considered an investment vehicle, a mutual fund. A lot of investors, retail investors, are familiar with mutual funds, pretty publicly accessible. Hedge funds, on the other hand, are more on the private side. So typically you're going to allocate to those, privately through an investment manager. They're very popular with very high net worth individuals and institutions. A lot of pensions, endowments allocate to hedge funds as a part of their diversification strategy because hedge funds are typically fairly illiquid, meaning you can't just pull your money out at any given time. And they have, lockups associated with the strategies. And I think when you get into the kind of innocuous nature of hedge funds and why people don't really fundamentally understand them that well is because hedge fund is kind of a blanket term for what these investment vehicles are. And they cover a wide range of strategies, including long short strategies on equity where they may, be invested, with positive view on equities, but also against certain equities. A typical case of a long short fund is, hey, I'm going to go long Home Depot, but short Lowe's because I think Home Depot is going to do better than Lowe's, but you're not really too exposed to, the home improvement, area of the market that way. Another is distressed equity or distressed credit, where you've got, subprime borrowers issuing debt. You're going to invest based off of your hope that something that's worth, nickels on the dollar is going to resume back to a buck plus. Same with equities. That may mean, very depreciated stocks. You're going to invest in those and hope for really big upside because you've got some kind of insight or proprietary data. Other strategies include global macro, where you're investing around, central bank actions or big, geopolitical events. And then one thing that we're going to talk about today is what's called multi-strategy, which can be a combination of all of these things. May involve investing in futures markets where you're trading things like, wheat futures or oil futures or other kinds of commodities. Or you're doing some kind of quant analysis where you're running 1 million trades a minute, trying to eke out, pennies at a time in order to achieve some kind of return. So, hopefully some of that breakdown, I know even that sounded kind of confusing, but gives people an idea that this hedge fund, term is really a blanket statement for some kind of proprietary strategy and a fund vehicle that typically high net worth individuals and institutions invest in.
Yeah. And to that point, they can look very different from strategy to strategy. Some of these strategies, kind of like you were mentioning, those that revolve around, highly depreciated assets, those might not scale very well, which is why you see a lot of these funds being very exclusive, very hard to get into because they kind of have their AUM or total assets locked at a certain level, because after a certain point, you can't get tactical on these opportunities or, similar to like arbitrage funds. If you identify arbitrage in the market, that can only handle so many dollars passing through it. You can't have a $10 billion fund and, execute that arbitrage opportunity. So that's interesting from that perspective. And also you have, other vehicles or other types of hedge funds that employ lots of leverage. And that's a very common thing throughout a lot of different types of hedge funds. But the use of leverage is really big in, a lot of these long short funds or, different ones where you're borrowing and buying at the same time. Like a long short, you're selling one to buy the other. So you're net zero positioned generally, broad at a high level, you're net zero positioned between the two. So you don't really have to pay in a whole lot to execute that trade. So you can lever that up a whole lot with a very small amount of dollars. That Bloomberg article we mentioned took one case study of one of these very popular funds had $4 of leverage for every $1 of principal invested, which is truly astronomical in any other realm of finance.
Right. And I think especially when you're talking about returns that are generated from that, it can create very huge swings as far as returns go, because if all of a sudden that trade turns against you, well, you've borrowed all this money at a certain, whatever your interest rate may be as a hedge fund institution. But if that trade doesn't work out well, one, you've got to cover that debt cost, and the trade may not have worked out. So it's really, amplifying the variation of returns. And I think kind of as far as some history, I mean, hedge funds have been around probably, for the last, at least in some form of reasonable popularity for the last 50 years or so. And especially in the 80s, 90s, saw really good returns and gained a lot of popularity. Now, the term hedge originally comes from when hedge funds first became popular, first started being released. Well, what they were doing was really hedging positions in the market. And by hedging, I mean they were, buying puts or, buying calls or selling calls, using options in order to limit the downside of, when the market moves significantly in a negative direction, but they'd also kind of limit your upside as well. And the idea behind a hedge fund was, hey, we're not going to blow it out of the water every single year, but we're going to get these, high kind of single digit returns over an extended period of time. That's going to be attractive. It's going to limit the downside whenever there is a big market downturn. Well, the thing is, because of all the strategies that we just listed that are getting lumped under the hedge fund bucket, they're not really just option strategies anymore. I mean, the traditional long short was kind of the, very popular strategy for hedge funds back in the day. And now it just covers this wide gamut of strategies, which leads to the confusion, the opaqueness of the hedge fund industry. And I think when it comes to a lot of these strategies, they are very black box. So, and this is why you and I, we are not big allocators to hedge funds. We don't really allocate any of our client funds to hedge funds, because one of the big things that we preach on so much is knowing what you own and why you own it. Well, if the only reason that you own something is because on paper the returns have been, decent over an extended period of time, sure, you can make a case for that, but we like knowing what those underlying, investments are, and you really don't get that from hedge funds. It's very black box. The strategies are proprietary, and I understand, for a good reason. If you've got some secret sauce, you don't want to let that recipe out, right? But it leads to this, kind of mystery behind a lot of these hedge funds.
Yeah, and to that point, people use that mystery to kind of, interject themselves into, start their own hedge fund, interject themselves into this, be like, hey, look, here's a track record, and we can totally continue to do this, whether or not it's really repeatable, or if it's, a couple years of identified an opportunity here, identified an opportunity there kind of thing. And then to revisit one of the points that you've made earlier, but I just kind of want to highlight this of them being hedged. Truly hedged, like you mentioned, the long short is if you're long Home Depot, short Lowe's, like you use for an example, then you're really taking that broad consumer segment out of it, all of that risk of, hey, if, people stop spending on their houses or start spending on their houses a whole lot, you're kind of, impartial to that because it's all just relative performance, one versus the other. It doesn't really matter if the economy is going really well or really poorly. it's, you're hedged from that perspective. You're not supposed to be taking that market risk.
Right.
Which, is, I think, a very important part of, at least in principle, what they should be or were at once upon a time. And doing all of these strategies, all of these very complex positioning tactics, it leads them into a situation where they can kind of justify having a higher fee, because there are expenses that go into this. These are very technical people generally that run these hedge funds. And, so you're going to pay up for that talent. And hedge funds really, really pioneered the 2 and 20 fee structure. So it's a 2% management fee on all of your assets invested, as well as 20% of performance fee, or, sometimes that has certain stipulations to it, but essentially 20% of any gains that you make, sometimes over a certain level, but just 20% of performance. So that's a high fee, especially compared to, elsewhere in the finance world where we sit, where, 2% fee by itself is astronomical. But, and kind of, I think that is going to gear us more towards, talking about these fees and, just kind of how that's changed over time.
Yeah. And I think that's one of the problems facing hedge funds now is that fee structure, because increased competition has put pressure on some of those fees. And what we're going to talk about is some specific funds that, kind of fall outside of that, pressure as far as the fee situation goes. But it's really interesting because you're talking about an asset class, a group of firms that haven't seen the most amazing performance in recent history. Over, like I said, the 80s, 90s, early 2000s, a lot of hedge funds had very good performance, either beating the market or especially in market downturns, far beating, S&P 500 returns. But over the most recent decade, returns have not really looked so good, especially over the past few years. You've had funds, in the, low to mid single digit range where the market's up in the teens or, 20 percentile return type range, which creates a lot of pressure, especially when you're layering these fees on top of those returns. You're saying as an investor, hey, is this fee really justified by the return you're getting me when I could be doing XYZ in public markets, getting substantially larger returns? Well, maybe all of a sudden that fee looks a little less attractive. And especially with this article that Bloomberg put forward, really diving into some of these pass-through fees on multi-strategies, it's really amazing to see how much hedge funds are able to put on the investor from a fee perspective. And it's going to be interesting on a go-forward basis as to how much investor pushback you're going to get because of this.
And that raises a really interesting point of the kinds of things that these firms are passing through. So already they have high management and performance fees, but now they've gone to this pass-through fee structure where they're passing through to the investor all sorts of fees, pretty much any fees that they can think of. It's, from office space to travel, sometimes even private jet travel. You're talking about accounting, back office stuff, printer paper was listed. It's amazing how many individual things these companies have listed and how that list just keeps growing and growing year after year of different things that they pass through to the end customer. And to that wildest extent, some of these firms have started publishing lists of things that they don't pass through. They'll, instead of saying we pass through all office furniture, office appliances, yada, 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 they'll come out and specify we don't pass through artwork on the walls, stuff like that. It's kind of to an insane level in a lot of these funds. And I think you have a few examples of, what that really looks like to the end investor, because someone has to pay for this at the end of the day.
Yeah. No, you're exactly right. And it is fascinating because in 2023, I saw a report by BNP Paribas, a big bank, saying that multi-strategy funds kept 59 cents of every dollar they made for investors. That was in 2023. So you're talking about over half of all of the returns that you made for the people you're investing for went back to you in form of some kind of pass-through fee, a combination of the management fee, the performance fee, those pass-through fees. And when you're talking about these pass-through fees of, office space, travel, sometimes luxury travel, food, office expenses, as you mentioned, and a lot of the services, the data that you use, it's really pretty amazing that you're able to pass that off on the investor. And we'll kind of get to why they're able to do that next. But I thought it was really fascinating to see that in 2023, one fund that had a gross return of over 15% ended up issuing the investor a return of less than 3% because of all these pass-through fees. So you had, of course, your typical management fee that's always going to stay consistent. You had a performance fee on that 15%, but then you had pass-through fees that whittled the investor all the way down to roughly 3%. And a lot of that, of course, hedge funds are saying, well, we have to pay for the data. We have to pay the compensation for these. A lot of times they've got very sophisticated scientists, PhDs, quants, engineers that they use to inform their strategies. But being able to pass all that through where you started with a 15% return and now you've whittled it down to less than 3 is pretty incredible.
And to that point, I think it's interesting to draw a distinction between things that investors are very commonly willing to pay for, like really good people, very smart, very specialized people are going to demand a premium. They're expensive. Like that's understandable. What's not understandable is seeing some of these firms listing non-investment related travel, like non-company travel, just pure fun travel, vacation, getting passed through to the end investor. And that's I think where personally my problem, and I think a lot of investors' concerns lay, is when you start seeing the just gross overuse, boiling a 15% return down into less than 3. Obviously that's going to have to be an outlier because that's not a sustainable business model.
Right. And I think it's interesting because you have to get to the why at the end of the day. Why are they able to do this? Because, investors are still investing with them. They have been more or less aware of these pass-through fees. Of course, they're not going to come out as a single line item on their statement and say, hey, your pass-through fee because of compensation, travel, our food, our entertainment is this dollar amount or this percentage. It's a little bit, more obscure, but they're willing to pay this because a select handful of funds have generated very, considerably strong returns. And I think that's where you may hear of the popularity, if you're a retail investor, of, these great hedge fund strategies, a 0.72 or a Citadel. But the thing is, it's really only a handful of firms that have this extreme popularity and desire to have dollars allocated to them, where there's a broad swath of hedge funds that are not getting the same attention. And it is, of course, you have to have a good track record if you're going to push through all of these fees. And what this conversation is today isn't a total indictment of the hedge fund industry. It fits certain investment strategies. It may not be our favorite area of the market to allocate fresh dollars to, especially in the alternative space. But at the end of the day, they're able to charge what they're able to charge. And if investors think that that's okay, then that's good. I think the most important part about these articles, like the one from Bloomberg and others, is just shedding light on the fact that, hey, these hedge funds aren't just charging you what already seems expensive at a 2% plus 20 carry. They're also charging these pass-through fees as well.
Yeah, exactly. And something that you kind of brought up is the wide dispersion in hedge funds, is that your top performers can perform very well. In 2022, the average hedge fund returned negative 1%, give or take. And you have Citadel, like you mentioned, they returned 60% gross, 38% net. Even that's a lot of fees, but 38% net is still a very good return when the broad hedge fund market did -1. And so you can have your top quartile performing usually several times that of the bottom quartile managers, and your average kind of somewhere in between. And so if you can, get in with these top quartile managers, it makes sense for a lot of people. But like I mentioned earlier, a lot of times, for this is limited to, your big players, your endowments, your, college endowments, other forms of endowments, charities that have been doing this for a very long time and have relationships with these managers that go back decades. And that's how they get involved in these funds, which have to be capped a lot of times, like I mentioned earlier, in order to go after the really profitable strategies, their true secret sauce that you mentioned. And, whereas a lot of the other hedge funds might not have the same luster to them. And obviously returns kind of point to that as well.
Yeah, I think that's a theme just across the alternative space and private markets in general, is that manager dispersion varies very significantly. Now, if you were to look in public markets and say you're just allocating to some ETFs and you want a technology ETF, well, the dispersion amongst those funds is going to be relatively small between top quartile and even bottom quartile, active manager, because they're going to be allocating to a lot of the same, tech companies within the tech ETF kind of realm. Well, on the other hand, in private markets, you've got essentially the whole investment universe to be allocating towards. Like we mentioned all of this fund strategies at the top of the episode, you're talking about global macro, futures, long short equity, distressed credit and different types of debt. So whenever it comes to the fund manager, between that top quartile and that bottom quartile, you can have significant differences in returns. And I was looking over the last 10 years and, your median hedge fund manager underperformed the market. And so if you're allocated to a very top tier hedge fund manager, great. But if you happen to fall even in the middle or the bottom half of that, it all of a sudden the attractiveness of those investments really lose their luster. And that's just a point for end investors. I mean, I'm sure that not many of our listeners are actively allocating to hedge funds through their investment advisor. But if they are, I think, make sure that if you're doing that, you're at least getting access to some of the higher quality ones, because something important about our business is that it doesn't make sense to diversify just for the sake of diversification. Just because there's a new asset class that comes out doesn't mean that you should throw money at it because it's something different, And that's why we don't do a lot of hedge fund investment, is because, there's a lot of dollars being attracted to these very few funds. I mean, BNP was mentioning, hey, there's maybe, 3 or 4 funds that are really worth investing in on the hedge fund side in the multi-strategy space. But otherwise it's like, hey, you might as well look in other areas of private markets, because there's much more attractive areas where you can allocate your capital.
Yeah, I think that's a really good point, because hedge funds do show, like, on average hedging value. 2022, they returned -1. The S&P did considerably worse than that. 2022 was a really bad year for the S&P. However, once you add all of these fees on an average hedge fund, then it opens up a lot of other hedging opportunities that you can, are now in the form of ETFs or, other vehicles that used to not be so available. Whereas now you have other options to pursue, and generally in finance, when you're getting a return, there's some amount of, you're usually being compensated for taking a risk. And if you're taking presumably a lot of risk to get that return and then taking a bunch of fees out of it, then it's just not a great return per unit of risk that most of these funds are, exposing you to.
Well, I think we gave our listeners hopefully a lot to think about when it comes to hedge fund space. Hopefully for anybody who wasn't familiar with hedge funds at all, or had heard the term but didn't really know what they were, hopefully we were able to shed some light on that. And then also for any listeners out there that are interested in what we have to say about hedge funds, they should drop us a comment. We can answer questions on the YouTube channel. And if anybody has any specific questions about hedge funds, of course we said it is a very kind of mysterious space that a lot of retail investors probably aren't super familiar with. So we're always happy to comment back on those.
Yeah. And I want to use this opportunity to point out a podcast that you did with one of the advisors, Justin, a couple months ago, talking about some more private market opportunities that are out there that I think are a little bit more compelling in the modern day, excluding, your top handful of hedge funds. So if anyone's interested in other private market opportunities, I'd encourage them to go watch that podcast. You and Justin did a great job on it.
Well, Hunter, thanks for the plug, and thanks for joining me today.
Yeah, thanks, Victor.